Thanks for joining, everyone. I'm Rob Tetrault from robtetrault.com, portfolio manager here at Canaccord Genuity Wealth Management and at the Tetrault Wealth Advisor Group. Thanks for joining. Really interesting guest I got on today. Last time he was on, he made a few bold predictions and they pretty much all came true. He wrote a piece last week, about a week and a bit ago, and I emailed him when I saw the piece. I said, Javed, I want you back on the show. He's coming back. He's back on the show. Let's bring him in. Let's delay him no longer. A man who doesn't need introduction, but I will introduce him anyways. Javed Mirza, quantitative technical analyst and researcher from Canaccord Genuity Corporation. Welcome, Javed.
Perfect, Rob. Thanks so much for having me.
I'm going to pull up a slide here on sentiment, I think is the next slide we want to go to.
Okay.
So this one you talked about, and I believe that the reason you mentioned it is the S&P 500 advanced decline. Be a tad too zoomed in here.
No, it's perfect. Just go down and go down. That perfect, and then just scroll over to the right. That's perfect.
Yeah.
So this chart at the bottom is the S&P 500, but that's not as important. What we're looking at here is a couple of indicators that really caught our attention. And so we highlighted them with those red circles. So the top panel, the third panel there, investor sentiment. If you recall, Rob, a month and a bit ago, we were very bullish. And the reason was, by and large, investors weren't buying what was going on. And so not this week's piece, but the previous week's piece, we actually called it the jig is up. And the reason we called it the jig is up is because if you notice right there, investor sentiment had started to turn up. So you see how it was below that blue line? Yeah, what that is telling you is that investors were very bearish. But over the last couple of weeks, they'd started to get bullish. Now, if you scroll down a bit, take a look at what happened to the S&P 500. It just kept moving higher. So as it kept moving higher, that literally one four-letter word, FOMO, right?
Yeah, nobody wants to miss out the party.
That's exactly what happened. So, and when everyone else is partying, that's when I get scared, right? So when everyone else is scared, that's when I'm very happy. So that's why back in March, we said, look, we think it's a V bottom because there was a lot of fear and a lot of panic. Our job, for lack of a better word, is to predict the future, right? And it's really hard to do. But there's a great series by Isaac Asimov. You ever heard of Foundation?
Yeah, I have. My sister's a big fan.
Yeah, and what the foundation, all it's based upon is they predict history based on the human population at large. So it's hard to predict an individual human's behavior, but the one thing that hasn't changed for the last 100,000 plus years is how we as humans behave, right? So that's ultimately what I'm doing, is I'm trying to predict what humans as a whole will do. So if you move back up to that indicator, so that's why over the last couple of weeks we've been getting a little concerned. And then right underneath it is another indicator, which is called the CBOE put call ratio. That indicator is actually, it's basically an indicator of fear and greed. When people think the stocks are going to go up, they buy calls. And when people think stocks are going to go down, they buy puts. So exactly where Rob's cursor is right now, what you can see is on the June 7th, when we put this together, almost everyone thought the market was going to go up. So that's why we were very concerned. And that's why we put out this note. Look, all these factors are coming together, which suggests the market's going to pull back. Now, as again, I would say, did we know it was going to pull back 7% in one day? No, but we knew that all these indicators were aligning such that there was going to be a corrective phase. So that's why we wrote it. And that's why we put out that note saying, look, the risks here are of a correction, and we think it'll come back to around 3,000 on the S&P 500, and that's ultimately what ended up happening.
Puts and calls, for those of you who don't know, are derivatives. So these are derivatives. So these allow you to buy the right for something to happen. So when you're buying a put, you're buying the right to sell something at a future date at a specific price. And if you're buying a call, you're buying the right to buy the market or an index or an underlying at a specific price. So you're basically it's a derivative. So it's a form of effectively gambling on what's going to happen in the future, and it's leverage because you can oftentimes pay a very small price for a future move of an index, and if it goes up 10 times that much, you only paid $1. You could leverage your returns dramatically, and that's why Javed monitors this, because a lot of the gambling money ends up being put on puts and calls. I think you would agree, and some hedges as well. So if individuals are hedging a portion of their portfolio, they might put a put on a portion of their portfolio. Javed, should I go to the WTI slide or the?
Yeah. Whatever you think is most topical.
Yeah, give me 1 second. I'm going to pull it out. In the meantime, you had talked about. So today energy closed at 37.07, up 81 cents.
Yeah.
That's not as high as it had been. Obviously, in the past, we saw the same trade that happened on the equity markets.
Yeah, that's perfect right there.
Yeah, you know what? I'll go back to the other one. It's good size.
Yeah.
So this you put out 8 days ago.
Yeah. And so what we highlighted is that we're just cautious here. And if you actually move over the slide, move just over to the right, I can talk about just the daily chart. So what we highlighted here, that red shaded box, is just, we said, look, this a move into this zone is where we would look to lighten up on energy. And what I can do is, I'm just at my computer right now, and I can just take a look to see where we ended up getting on crude. So what's happened is we've come right into that zone right here. So it's between 41.28 and 34.36. And so if you take a look at the weekly chart now on the left-hand side, so that's where we would be lightening up on crude. So do you see that 40 level?
Yeah, right here, 40.06.
Yeah. And so what you can, if you move across that line where it says 40, what you can see is that over time, it's been support and resistance. And you can see that very clearly with 50 as well. Notice over time, 50 has been a pretty good barometer of where it moved higher when you're above it, or it bounced off it. You see that exactly right there, Rob. You see how it's like, exactly, a lot of times where it bumped up against it and then failed, or where it finally moved higher. Now 40, especially if you go back to 2016, 2007, exactly right there.
Here.
Exactly. Notice that it was a pretty big support level initially, but what it is right now, it's a big resistance level. So notice where we are now. We've had that big rally right to that level.
Yeah.
And as you know, things don't go up forever. So especially if we think that the market's going to consolidate, then crude, which is more of a risk on and cyclical commodity, should come off as well. Now, what's really interesting is take a look at the bottom panel. And what that is that's a measure of smart money. The red at the top is hedge funds, and that's how many contracts they have open. And the green line at the bottom is commercial hedgers. So these are the producers of the underlying commodity. And what they're looking to do is hedge their production. And they are the ones that typically have the most information. And what we've highlighted with those blue shaded boxes is whenever commercial hedgers are very short. So if you notice throughout the history of that data series, they're always short. So they're always below that zero line, that kind of horizon line you can see there. But there's instances where they are very short. And so what's happened over the last couple of weeks, especially as we've had this rally, is that they've sold into this rally, and now they're positioned at levels where traditionally, once they're positioned at these levels, you tend to see a pretty decent correction. Now,
so the idea there, Javed, the idea there, just sorry to interrupt, is that these commercial hedgers, they're often running very large ag companies, and they're actually truly hedging their crops, or maybe they're feeding animals or whatever it may be, or they need oil for to put into their factories or whatever it may be. But that is what you would call the smart money, just so I'm clear.
That's exactly it. So who would you rely on
Absolutely.
Who would you rely on for a grain forecast? A farmer in Manitoba or some trader in Toronto?
Yeah, no, I'll back my farmers here in Manitoba. Absolutely.
That's exactly it. That's what I look at, and that's what these guys are saying.
We've talked about this. We've kind of followed this and talked about this here internally with my dad and I for years. How they're always going to be right, because those traders. Well, they got real money on the line, these hedgers, and they're truly trying to hedge risk in their portfolios, and it's long-term decisions, right?
Yeah, and salt of the earth. They know what's going on, right? And they've been doing it for years, and it's in their blood. So, and that's what we're looking at, is I want to see what the smart guys are doing. And what the smart guys are doing is they've started to reduce their exposure to crude here, and they've locked in prices, and effectively they're locking in their exposure at these levels. And when they do that, it means they don't think it's going to go higher, or at least not in the intermediate, over the next couple of months.
Can I ask you, so for stocks, would you agree that, or would you think that for oil prices, the kind of the numbers in the sand of 40, 50, 30, 20 mean more in commodities than they do for stocks, or is that not true?
It's funny because certain stocks have trade
psychological barriers, right?
And this has happened from way back, and I'm sure your dad will remember this as well, is basically in the 90s, 2000s, you had guys who were pros on certain stocks. And so whatever the pro traded, he would be a big mover of money. And so every pro had different, they used different levels, they used different tools. Some guys were fundamental only, some guys were technical. So the professional or the proprietary trader, he would often dictate how a stock traded. So I would say it's individual for a stock. So like a Microsoft would trade a bit different than an Apple in terms of key levels. But sometimes you do see that, especially in commodities. There's this theory called Elliott wave theory, which I don't really get into, but I'm sure some of your viewers might know about it. And commodities definitely seem to follow that Elliott wave theory a lot more.
So the psychological numbers, they move up and down, and I guess the traders. Can you talk maybe a bit about the pros? Wait, before I do that, I'm with Javed Mirza here on YouTube. Please take a second and subscribe. Can you explain what a pro trader is for our viewers, and how many are there in Canada? Would there be one at every bank? Would there be one at every investment firm? How did they work back in the day, and how do they work today?
Yeah, so there's actually less and less ever since the financial crisis. They've really regulated and pulled that back. But basically what happened is the banks used to have excess capital. They'd have trading desks, typically of 10 to 20 people, and they would just make bets based on what they saw happening in the market. So these guys were, really smart guys, because you could tell, because their livelihood was based on whether their bets on the market were correct or incorrect. But after the financial crisis, you had all this regulation, and it made it really difficult and tough for the banks to continue with that. And there's pros and cons of having proprietary traders. Obviously, the con is, the more risk taking, but the pros is that you have more liquid markets. So, and because they'd be forced to hold inventory in certain names that they were the pro on. So it would make for more liquid markets and for better price discovery.
Right. And less machines, right?
Yeah. And they've been effectively replaced by machines.